In today's video, we are going to explore CISD, which stands for Change in the State of Delivery. It is a concept many traders misunderstand or see on the chart without fully knowing how to interpret it correctly. So here I will break it down step by step in a clear and practical way. I will show you how it forms by walking you through how price shifts from bullish to bearish, or from bearish to bullish, directly on the chart. The goal is to help you recognize that transition in real time instead of guessing. Then I will explain why it works, focusing on what is actually happening behind the scenes in terms of order flow and price delivery. By the end, you will understand why the market reacts the way it does when a CISD forms, and how to spot setups that look clean but lack real context, so you can avoid low-quality trades and focus only on higher probability opportunities. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, a change in the state of delivery happens when price transitions from a bullish phase into a bearish phase, or from a bearish phase into a bullish one. But what does that really mean in practical terms? Think about it this way. The market is always moving with a certain directional intent. When price is advancing consistently, that reflects bullish delivery. When price is declining consistently, that reflects bearish delivery. A CISD appears when that directional behavior shifts. Instead of continuing along the same path, price begins to show signs that control is changing. So the key question becomes, how can you identify that shift as it happens? This is where attention to detail becomes essential. In most cases, a CISD can be recognized when price closes below a bullish candle, or when it closes above a bearish candle. Let me clarify this so it is completely clear. A bullish candle is simply one that closes higher than it opens, while a bearish candle closes lower than it opens. If price moves down and closes below the open of a bullish candle, that indicates a transition toward bearish delivery. On the other hand, if price moves up and closes above the open of a bearish candle, that indicates a transition toward bullish delivery. Another important point to understand is that a CISD is not limited to one or two candles. It can also develop across a sequence of candles moving in the same direction. For example, if price impulsively moves away from a group of bearish candles and closes above their opening levels, that still qualifies as a valid change in the state of delivery. In the same way, if price breaks below the opens of a series of bullish candles, that also represents a valid CISD. Now, a common question traders ask is what the difference is between a CISD and a market structure shift. This is where a lot of confusion comes in. For a CISD to occur, you only need price to close above or below candle opens. The focus is on the candle bodies, not the wicks. However, for a market structure shift, price must break and close beyond a swing point. So you can think of it like this. A CISD is an early signal that something may be changing, while a market structure shift is a more confirmed structural change in the market. Now, one important detail to mention is how we approach execution at ComLucro. In most cases, we prefer to mark the wick of the candle that caused the CISD and use that level for entries, as it provides an extra layer of precision and safety. However, for the purpose of this video, we will keep the examples in their standard form to ensure clarity and simplicity. Now, when you look at the chart, you will start to notice something interesting. Some changes in the state of delivery follow through cleanly, while others simply fail. So the real question becomes, how can you tell the difference between the ones that actually work and the ones that do not? Let's begin with an example of a failed setup. When you move to the higher time frame, in this case the 1-hour chart, you will see that price was sitting in what I refer to as a no man's land. There was no reaction from any meaningful level, no respect for higher time frame flow, and no clear directional bias. Price was essentially moving without structure, and that is exactly why that specific CISD did not hold. Now compare that with a setup that performed well. In that case, price was positioned inside a fair value gap, and reacted from that level before forming the CISD on the 15-minute chart. That context is what allowed the move to play out. So what can you take from this? It shows that context is critical when identifying a high-quality change in the state of delivery. Not every CISD is worth trading. To find stronger setups, you need either a higher time frame point of interest or a clear higher time frame bias. Let's break this down further. A higher time frame point of interest could be something like a fair value gap or another key level. You identify that area on the higher time frame, then drop to a lower time frame and wait for a CISD to form from that zone, aligning with your intended direction. When it comes to bias, the process is straightforward. You first define whether your expectation for the day is bullish or bearish. Once that bias is clear, you move to a lower time frame and look for a CISD that aligns with it. If your bias is bullish, you focus on bullish CISDs. If your bias is bearish, you focus on bearish CISDs. This approach helps you avoid random decisions. Instead, you are trading with clear direction, structured reasoning, and proper confirmation. Now let's move to the chart and apply everything we have discussed to identify high-probability CISD setups in real conditions. In this first example on the 4-hour chart, you can clearly see that price has been trending to the upside. There was a bearish fair value gap that price initially ignored, which effectively turned it into an inverse fair value gap. At the current level, price returns to that zone. From there, we drop down to the 15-minute chart to look for a CISD, because now we have proper context. The higher time frame is bullish, and we also have a well-defined point of interest. On the lower time frame, price closes above a sequence of bearish candles. That confirms the change in the state of delivery. From that point, we execute the trade and aim for a 1-to-2 risk-to-reward ratio. As you can see, the setup unfolds cleanly. Now let's go through another example. On the 4-hour chart, price is positioned inside a bullish fair value gap. We also have a break of structure to the upside, and price is reacting from internal range liquidity, which suggests continuation to the upside. Next, we move down to the 1-hour chart. Here, price reacts from another bullish fair value gap and pushes higher, closing above a group of bearish candles. We take the entry from that level, place the stop loss below the low, and once again target a 1-to-2 ratio. The trade plays out smoothly. This highlights how combining higher time frame context with lower time frame confirmation can significantly increase accuracy. Now let's approach this from a different perspective. In this example, we use the daily chart to define bias, the 4-hour chart to provide context, and a lower time frame for execution. On the daily chart, price is reacting from internal range liquidity, which suggests that external liquidity is likely to be taken next. This immediately gives us a bullish bias. Then on the 4-hour chart, price sweeps liquidity from previous lows. When we drop down to the 1-hour chart, we can see a CISD forming right after that sweep. This is important because it shows that sellers were trapped and price transitioned from bearish delivery into bullish delivery, aligning perfectly with the higher time frame bias. With all time frames pointing in the same direction, we now have strong confirmation. From that level, we take the entry. In this situation, you can afford to be slightly more aggressive with your stop loss because of the added confluence. Price respects the level and continues moving higher. In the final example, we use the same time frame for both the point of interest and the CISD. On the 1-hour chart, price is trending upward and forming a higher low within a fair value gap. The move into that zone is corrective, which suggests a higher probability of continuation. Price then reacts, pushes impulsively to the upside, and closes above a sequence of bearish candles. We enter from that level, place the stop loss just below, and once again target a 1-to-2 ratio. Price reaches the target cleanly. So these are the main ways you can approach trading the change in the state of delivery. You can operate on a single time frame, combine higher time frame context with lower time frame confirmation, or align bias and execution across multiple time frames. Regardless of the approach, everything must be supported by context. Without context, consistency becomes difficult. With context, identifying high-quality CISD setups becomes much more reliable. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.